Hey, good evening, everyone. Marty Mazzora here. It is the 9th of February, 2026, with an update for you. Want to definitely touch base on some of the developments over the last week. I'll use my notes to help me do that. Want to talk about precious metals, of course. Spent a little bit of time on the stock market, a little less time than usual, I think, because of other things that are just, maybe a little more interesting or a little more pressing at the moment. So let's start with my notes. So today, I posted this because I watched a clip of Ray Dalio talking about the debt problem that we have and that it is or will be followed by devaluation of the currency. He's quite the historian. And the person who posted that said, looks like this is exactly how the U.S. will handle its debt problem. Kevin Warsh, the soon-to-be Fed chair, we presume, will peg short-term rates to artificially low levels and buy treasuries to keep them down, inflating the debt away. We saw this play out in the 3 decades following World War II, and it's plausible that the U.S. is preparing for a similar maneuver as debt to GDP is currently above 20% or 120%. And that's why central banks are dumping U.S. debt and buying gold instead. I don't know that that's the only reason. We've talked about other reasons why they may be doing that. But as I've stressed for quite some time, I started this is precisely the narrative we've been expressing since we added gold back in, actually it was December 2019. And those of you who've been with the blog for the last few years and clients who've listened to me rant during our reviews when we get on the subject, there is a precedent for periods where the U.S. is over 100% debt to GDP, actually a precedent, and that was World War II. And essentially the Fed and the Treasury got together toward the end-ish of the war and decided to implement a strategy of yield curve control. Again, massive debt relative to GDP, inflation coming, a whole lot of war debt which was very short-term in nature, to refinance over the coming years. And with rebuilding in various parts of the world and bringing the soldiers home, running big fiscal deficits, it's going to be inflationary. So if we have an inflationary backdrop, yields are going to rise if we let the markets do their thing. So the idea was, well, we don't want to issue a lot of debt to fund these deficits and to refinance the war debt in an inflationary or in a higher interest rate environment. Again, that just compounds the problem because the cost of the debt goes up along with issuing the new debt. So the Federal Reserve essentially implemented this yield curve control where as the Treasury would issue its debt, to the extent that the outside world, investors, both domestically and internationally, weren't buying enough of it to keep the yield at, back then, 2.5% pretty much across all durations, then the Fed would step in and do the heavy lifting. And they did that. And essentially what they did is that they ran the economy hot. They inflated away the debt, or I should say the debt to GDP ratio, or the dollar cost or the dollar value of the debt. The debt actually kept going up, as our government debt always has. None of it gets paid off. But by capping the cost of that debt, they were able to refinance and issue new debt at then very low interest rates. And that, of course, also suppresses lending rates as well as the interest rate on your savings account and so forth. So therefore, more money then has the opportunity of going out into the economy, inflating financial assets, being invested in other things, and so on. So essentially what was allowed to and meant to happen was, with all this government spending, and then at least Treasury interest rates not reacting to that inflation, we were able to kind of keep the economy humming along at a pretty robust pace. And any recessionary periods would be modest because you've got all this government spending and you've got a low interest rate regime already. So while interest rates are 2.5%, the average inflation rate during that 1943 to 1952 period where they actually did this formally was around 5.5%. So we actually had negative interest rates of 3%, meaning you earned 2.5%, but the cost of everything went up 5.5%. Therefore, you were losing to inflation to the tune of 3.5%. Gold is just an ideal commodity to own as an inflation protector in a situation like that. Of course, we were on the gold standard, so it didn't get to happen. This is different today because we're on just the fiat standard, if you will, and gold gets to move, as you've noticed a lot the last few years. So we wake up 9 years after implementation with debt to GDP well below 100% and very manageable, literally for decades beyond that. And so the way you go from 120, say, to 80 in 9 years is not by paying off any of the debt. It's by letting nominal GDP grow. I've said this to you many times before, that if you and I buy all the same units, the same number of units of goods and services this year versus last year, but the price of everything goes up 5%, then GDP, the sum total of all the goods and services bought and sold in the economy, would go up 5%, the dollar value, even though there was no increased activity. So that's what they mean by inflating away the debt. Our dollars essentially are worth 5% less, or we can buy 5% fewer things the next year. And if we buy the same units and the price goes up, then GDP continues to go up. And if we can keep debt relatively low, or the pace of debt growth slower than the pace of GDP growth, well, then we end up curing the over 100% debt to GDP problem. So notice here that there's a snip here from a publication. I'm not sure which publication, but the short-term interest rates debate in $30 trillion bond market. Kevin Warsh has called for a new accord with the Treasury Department, overhauling the relationship between the two institutions. So essentially, this is literally exactly what we were talking about 5-6 years ago. So that's to come, I'm quite certain. And that jibes very much with how we're allocating our core portfolio going forward. Also yesterday, very interesting, this flies in the face of equity markets' fears over debt-financed AI bailout going forward. So, a year ago, these billions that these hyperscalers were spending on AI data centers were spent out of cash flow. And now they're borrowing. Well, this little article here talks about how strong the demand was for Oracle's debt. And they're one of the suspects there in terms of the borrowing and maybe the stress that they're seeing. Their credit default swap cost, which is insuring their bonds, went up a bit here recently. There is no lack of demand for that. Today, Alphabet/Google issued a bunch of debt in various currencies, not just the dollar, with overwhelming demand. So there seems to be very little concern among debt investors about the ability for these hyperscalers to pay this debt back in the coming years. So we'll keep an eye on that. Also on Japan, at the beginning of the year, we added Japanese large cap stocks, and then a week or two into the year, we added small caps as well. Here was kind of the brief narrative around that. Relative valuations, global fiscal expansion, and the below is why we bought Japanese equities at the beginning of the year. It'll be interesting to see what happens to the yen, which we also own. Consensus is resounding that she, and that's the new prime minister, is actually bearish, or her policies are bearish for the yen. I said, we'll see. If indeed this sucks capital in Japan and unwinds the proverbial yen carry trade, which we've talked about before, it could actually be bullish, or at a minimum quell the yen's decline. Could be bullish for the yen, or it could certainly be a tailwind against certain headwinds. One caveat suggesting that maybe it's not seriously bullish for Japanese equities, which is my base case that it is if her policies are considered too inflationary and yields spike too much. That could spell a sell-off early on, which would also jibe with the buy the rumor, because these things that we own have been up nicely already. sell the new setup. We'll see. Structurally, longer term, this is bullish. Well, we actually had a very good day. I think our two best performing ETFs today were these two Japanese ETFs. And what I did is I copied and pasted from the Bloomberg article yesterday announcing that she just won an absolute landslide. This is the greatest mandate for any ruling party in Japan since the war. And she has very, very specific pro-growth policies that obviously Japanese voters are excited about. In terms of investors like us, I've already been positioning for decisive victory, scooping up Japanese stocks and selling the yen and government bonds as they expect to embolden Takeichi to ramp up spending and so forth. Where I push back is on the yen devaluation. In fact, the yen today, and I've got a chart loaded up for you, was actually up nearly 1% on the day, which is a big move for a currency. And then on the 5th, which was Friday or Thursday, this from Bespoke this morning jives with our present thesis as well. German factory orders were significantly higher than expected. Now, a chunk of that was on defense spending, but that wasn't all of it. And that would be certainly not bearish going forward for the prospects in the Eurozone. And I'm going to talk about a sentiment indicator that came out today as well. And then I posted this on the blog that Mexico is unveiling quite the aggressive stimulus package. So this global fiscal spending is very much in tune with our thesis for 2026 and something that we're exploiting so far quite successfully year to date in the core portfolio. Okay, so let's jump to what I just alluded to, and that's that sentiment survey. So Centix, it's a European organization, but they do surveys of like 1,000 to 1,500 asset allocators, institutional investors primarily, and ask them what they think about economies on a current basis and then on a 6-month go-forward basis. So the overall global conditions, current plus 15, 6-month plus 15.74. Notice that is the highest in terms of optimism since all the way back to early 2022. So 4 years ago is the last time we had optimism this high about the global economy on the Centix index, both current and go forward. As for the United States, the current is actually a pretty robust 26. That's a high number. However, they are concerned about the 6-month outlook, significantly lower at 5.5. Eurozone, notice it's kind of the opposite. Current, negative 2.5, but 6-month outlook, which is kind of consistent with maybe what those factory orders portend, a high 24, which is also higher than it's been since all the way back to 2021. As for Japan, the subject of the day, current 16.5, go forward 13.5, a little lower. That'll be interesting to see next month if that picks up with the weekend snap election results. Asia ex-Japan, both look good in terms of sentiment, both current and 6-month. And then Latin American conditions, current, a relatively low reading of 5, but better, even that's better than it's been for years. But a outlook, 6-month outlook of 20.5. So again, this all jives with our view that all this fiscal spending is likely to have positive economic results during the course of 2026. To the extent that that fuels inflation, that's a whole other conversation we'll be having. Okay, so jumping to the charts, gold, right? So remember, I was warning like literally right up here about the prospects for gold getting walloped. And we actually rolled our hedge very close to the money. So while gold was down 17%, we had a hedge on that mitigated a pretty decent chunk of that. And we ended up rolling down as the price went down and quickly doubled our money on that hedge, or doubled our clients' money on that particular hedge. Then we rolled it to a much cheaper hedge, which of course is down a bit as gold has come bouncing back. We'll see how this plays out. Remember the monthly chart, I said that you just don't get out of these situations without a double-digit correction. Well, that was swift and relatively mild at 17%, considering what typically happens when we're this overbought on the monthly chart. What this could very well be, too, is your classic bear flag pattern. With the bear flag pattern, you retrace up and to the right, usually to about 50% of the move, which is about exactly where that is, by the way. I'd already measured it. And then what happens if the bear flag plays out is you roll back over, and your next stop would be the length of the flagpole, which ironically would put us right about at the top of this consolidation range where we sat between October and, say, the beginning of the year, ultimately. So it'll be interesting to see how this plays out. We could actually just be getting into another several week or several month consolidation phase. Remember, we had one last year. We ramped up here after a little correction and then just kind of moved sideways for about 4 months, broke out big, moved sideways for 2 months, broke out big. We'll see. This is concerning. Long term, as I just talked about, with yield curve control and other factors, we're bullish gold on a structural basis. But short term, it's out over its skis even still. Silver, wow. Biggest one-day drop in silver ever. It's like 31%. Notice kind of this bear flagging action in here, like in gold. And then we did break right back down in silver with this big gap right here, but certainly not the flagpole. And we've had a couple of big days, big gaps higher since then. So we shall see. Notice, and I think I did this on the last video, we had retraced 50% of the rally from the low in last April, and that's kind of a spot where you tend to get some support. Had a nice rally, came back, retested that, ultimately successfully. And remember, I said we had 2 layers of support right here, both the 50-day moving average and the 50% Fibonacci retracement. That's holding pretty nicely right here. We'll see. Got to be careful, I think. We really, really cut our silver exposure, which was, phenomenal for us last year and even through the month of January. But we cut it in half to start the year, and then we cut it again after it was up like 50% in 3 weeks. Just crazy, non-sustainable action. The dollar has been interesting. The sell-off in metals and commodities in general was consistent with quite the sharp rally in gold. Remember, I said at the beginning of the year, it wouldn't surprise me to see a rally. We got one. Then we dumped big, got down here to this 96-ish, which are levels we saw in July. These have been support levels, which have held up again right here. Kind of looks like a bear flag. This flag's getting a little bit long, but sure enough, we broke down the last couple of days. Big rallies in precious metals. Friday was a huge rally in the stock market as well. So we'll see. Dollar's going to be interesting going forward. I'll get into those weeds for sure. I mentioned the yen, just a short-term chart here. This is actually the position we express our bullish yen thoughts in. It's FXY. It's an ETF that follows the yen. And you can see today we just ramped right up there, which was not what consensus expected, to be honest with you. So anyway, we'll see. We'll see if our thesis is correct. But we would be bullish the yen. It'll be very, very volatile. But bullish the yen, structurally speaking, as well. And then just the Japanese positions that we have. We own EWJ, which from the beginning of the year is now up 13%. So this is this is Friday's big move, anticipating the weekend election. And then this is today's big move as well. Small cap Japan is up 12%. You can see, Friday's and today's moves as well. So it's been nice to add these to the portfolio this year. And then lastly, just the S&P 500, still kind of sitting right there at that late October spot, right? We've tried to come up there, hit a new all-time high and tested it 2 or 3 times, and then came off of that October level right there. So at one point got above 7,000, at least intraday. So we'll see how that plays out. Kind of a tight range in here. Swing traders, could buy the support, sell that resistance. We'll see if that goes on for a while. Recaptured the 50-day moving average on Friday. Confirmed that today. So we'll see. This thing kind of feels like it wants to break out meaningfully into new all-time highs. Wouldn't surprise me. Technically speaking, the way we work the technicals, there is some risk here. The momentum has been waning pretty consistently for about the last year, a little less than a year. And you can see as we've established this range right in here, the moving average convergence divergence continues to show a bearish divergence, as does the relative strength index. So this says probabilities favor a breakout below, but in this dynamic world we live in with policy threats and changes and adjustments seemingly daily, if not weekly, these things, the technicals are going to be suspect. They're not going to necessarily be that reliable. Our base case for 2026 is that geopolitical rhetoric will ease a bit. If we could have a ceasefire in the Russia-Ukraine situation in the course of this year, a somewhat of a workable agreement with Iran, and so on, and tariffs not going up, actually tariffs continuing to come down. I think these are all bullish scenarios. We know we're going to get a lot of fiscal spending. We know consumers are about to get massive tax refunds. This is all positive. Of course, the headwind there would be that if things are strong, inflation is not coming down, nor would interest rates. Anyway, all that remains to be seen, but from a fiscal spending standpoint, somewhat bullish. From a monetary policy standpoint, some are concerned. The people who we pay for their expertise on liquidity say that liquidity has peaked or liquidity growth has peaked, and they're getting concerned about financial assets in that scenario. I would argue that the fiscal engine, the Treasury, is picking up the slack for the Fed, but yeah, that's more about the real economy, and you want to be investing in real economy equities and assets as opposed to long duration financial assets that are helped more by the Federal Reserve's style or method of liquidity. Right now, they are buying about $40 billion a month of securities. So right now, that is net positive. But again, the rate of liquidity creation is waning notably. Our foremost expert who we pay for his research says that it's peaking, and for the first time in a while is concerned about the knock-on effect on risk assets. So lots to unpack there, I know. I rambled a little bit, but folks, just know that it's a dynamic setup we are managing through right now. You've already seen several tweaks to the portfolio. We're going to have to be quite tactical as we go. So far, so good. And I'll keep you posted. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.